we'll get started here. Welcome everybody to the Mountain West Small Business Finance Masters in 504 Lending Series. We really appreciate your participation in this. It's been great to have a bunch of you join on this monthly call. We hope you find it advantageous, and we really appreciate the camaraderie and affiliation. Today, the topic is 504 best practices, and our instructor today is Spencer Davis, who is our senior lending officer at Mountain West. He's been here since birth, pretty much. So we'll let Spencer take it away, and I will be monitoring the chat. So if you have any questions, please put your questions in there, and we'll either respond in the chat or we'll take time at the end or break Spencer's presentation up to ask some of those questions. So with that, Spencer, take it away.
Perfect. Okay, let's get started. I'm excited to be able to share a few things that we've learned over the years. So just first, a little bit about Mountain West Small Business Finance. We've learned a thing or two over the last 42 years that we've been operating as a certified development company in the state of Utah. We're the #1 504 lender in Utah. We're the #1 504 lender in our SBA region, and we're a top 10 504 lender in the nation. We're leaders and teachers in our industry. We do hundreds of these loans each year, and we help training other CDCs in the industry. So we hope that what all of that amounts to is that, like I said, we've learned a thing or two over the last 42 years, and we've learned what can make for a smooth process and what can make for a difficult process. Our goal when we work with you is to get the loans we work on approved and funded quickly. We want to meet deadlines. We want to be as simple and efficient as possible. We want to avoid surprises. We want you and your customer to be happy at the end of the process. And we, of course, want to be your #1 CDC. We found that when we're working on these loans, that communication is key. And when we have as much information about the loan as possible up front, it makes for a much smoother process. So we want to communicate with you as early as possible. And a lot of people want to know, what is the correct information to communicate up front? What do we need to know to make this a smooth process? So this presentation will cover that information, what is needed for us to know so that we can make this a smooth process. So first off, when you contact us about a potential project, we want to hear about the project. We want to know what it entails. Is it a straight purchase? Is it a construction loan? Does it involve equipment? Is this a refinance? What type of refinance are we looking at? Are we looking at a partner buyout? It's really important that we understand if there's any timing issues or deadlines involved in the project so that we can work towards meeting those deadlines. And why is all of this information important? Well, this helps us to know the kind of information that we need to collect for the loan. It starts to give us an idea of what eligibility items we need to ask about or cover. And it helps us know what the timing and expectation you have for us is. So in addition to talking about the different aspects of the project, we want to know the costs associated with those different aspects. So we want to know an estimate of what the hard costs are going to be, what your soft costs are going to look like. Will we have contingency, interest reserve, origination fees? It's important for us to discuss what interest rates are looking like for both you, the lender, and for us on the SBA side of things. And just something that SBA has requested that can be very helpful in making this be a smooth process is that once we've determined what that total project cost is, if it's kind of a random odd ending number, it's really helpful for us to just round up to the next hundredth. It's not something that SBA would ever enforce or require, but they have requested it, and I can see the sense in it. It makes it a lot more simple when we're creating that authorization to send to SBA. It helps avoid screen outs if there's potential rounding issues that we've overlooked. So it's really helpful if we are able to round up to the nearest hundredth. So why is all of this information important? So this helps us to know the kind of information, again, that we need to collect for the loan. It also helps us to be on the same page with you as we're moving forward with the loan. We want to next discuss the structure of the loan. So we're going to ask, how long have they been in business? Is the building general or special purpose? We want to know what the source of the borrower's injection is. Do they have funds available? Are they coming from the business? Are they coming from the borrower personally? Are they using a home equity line of credit? Is there a seller carryback involved? It's important for us to know that they have the funds to cover the injection from the beginning. It's important for us to discuss structure because we want to be, again, we want to be on the same page with you from the beginning of the loan. It has to be an awkward conversation when a lender tells a borrower, oh yeah, you can qualify at 10%. And then you come and talk to us and find out, oh man, actually it's going to be 15%. Then you have to go back to the borrower and tell them I was wrong. It's actually 15%. Not the end of the world, but it's always better if we have that figured out from the beginning and we're on the same page from the beginning. So really what all of that conversation does, once we understand the type of the project, the estimated project costs, the structure, what the interest rate, amortization, and term is going to look like, we can put together for you our sources and uses document. And this is a really helpful tool I've found to help borrowers understand the unique structure of the loan. It's a really great way for them to visualize what the loan looks like, because you can set the document in front of them. You can show them, here's all of the project costs that we're looking at. Here's how much of the loan is going to come from the lender. Here's how much is going to come from the SBA. Here's how much you need to put down on the project. Here's an estimate of all of the fees that are associated with the loan. And here's an estimate of what your monthly and annual payment will look like for this project. And so let me show you what that looks like. So here's an example of a sources and uses document that we can put together and send to you. So as you can see, we've got some estimated project costs for a project for Los Pollos Hermanos. It shows us what the estimated structure is going to be. For this one, we're looking at a 50-40-10. As we go further down, it outlines what all of the fees are going to be for the SBA part of the project. And finally, we can see and show the borrower what the estimated payment is going to be on the loan. So like I said, it's just a very helpful tool that you can use to help explain the project to the borrower. After we've discussed some details about the project and what it's going to look like, we want to understand more about the business or businesses involved. We want to know what entities are involved, who the operating company is there going to be an EPC? Are these entities owned personally or with a pass-through entity? We want to know what the OC does and what their history is. We want to know why they need this loan, or why do they want this type of financing. This information, again, helps us to know what information needs to be collected for the loan. It lets us know who the guarantors are going to be. And when we know who the individual guarantors are, that's when we know exactly what needs to be collected from each individual involved in the project. We'd like to have a quick discussion with you on creditworthiness of the borrower. It may be pretty early, and you may not know exactly how strong the loan is, but if there is an idea from the beginning, it's good for us to understand, is this a project that has a really strong repayment ability? Is it acceptable? Is it going to need projections? Let us know if there's any significant personal credit issues. We're of course going to do our own underwriting on the loan, but knowing some of this information up front might give us a clue or a cue that we need to do a pre-screen on the loan. And that's a way for us to take a really quick look at just the financial aspects to know if, yeah, this is a deal that we think we can get approved, or we can give you a quick no if we don't think it's a project that SBA would approve. And of course, we want to have a discussion about eligibility. So this is a list of items that I'm going to cover. I'm not really going to get into the specific eligibility reasoning or the specific eligibility rules, but we'll kind of talk about what pitfalls these eligibility issues can create if they're not met. So first up is occupancy. We'll want to cover if it's a straight purchase, refinance, or new construction, as occupancy requirements are different for each. It's important to know that the borrower's occupancy will be confirmed at 2 points during the origination process. The first is at application. So if an appraisal is involved in the project, we'll send that to SBA, and the SBA is going to look through that appraisal pretty carefully, specifically looking for any details they can find that talk about occupancy. They're going to look to make sure that what we've told them is accurate and supported by the appraisal. So if it's not consistent with what we've explained, they will screen out the loan, and we'll have to give further explanation to SBA to support that occupancy. The next point that SBA is going to take a look at occupancy is at closing. So when we close loans, we will request that you provide us with leases for any tenants that might be in the building. And if there are leases that are provided that prevent the borrower from meeting that occupancy requirement, then that could potentially prevent us from being able to fund on the loan. So those are the 2 times during the origination process that we are going to verify occupancy. All tenants, if there happens to be tenants in the building, they have to sign a subordination and non-disclosure agreement, our SNDA. And it's pretty common that lenders are going to want any tenants to sign those for them. So we found that it can be a very frustrating process if we happen to have a difficult tenant If they're already reluctant to sign the SNDA, they're even less likely to sign it for us if they've already gone through and signed it for the lender. And then months later, we come with the similar document for them to sign. They're frustrated because they've already signed it once. And it can make for difficult process at our closing. And we want, of course, to be able to fund the loan and get those debenture proceeds wired to you, the lender. So we have found that we've had a lot more success if we can get that SNDA signed, ours and yours, at the same time. So if we can coordinate with you, it's much appreciated, and it makes for a much smoother closing process. One more thing to note on occupancy: when we are doing a loan for multiple condo units, the borrower has to satisfy the occupancy requirement in each condo unit. So if they're buying 2 condos, one condo is larger than the other, and the initial thought is, well, I'm going to occupy 100% of the larger unit, and I'm not going to occupy any of the smaller unit. But if you combine those and it's over 51%, then I should be good. Well, that's not accurate when it comes to condo units. The SBA requires the borrower to satisfy the occupancy in each of the condo units. In the last couple of years, EPC regulations and rules have become a real hot button topic for the SBA. They're very focused on it. They pay a lot of attention to it on every application that we send in. And we've started to run into quite a few issues that we have to resolve because of this. So I will go over a little bit of the EPC eligibility on this slide. So the EPC cannot be involved in any other business operation aside from leasing the building to the OC. So something common that we see on new loans is a borrower has an existing holding company that they use for their residential real estate investments. They use it for maybe some other commercial building investments, and they just want to use that same entity to be the EPC for this new project. Well, SBA says that's not eligible because they own other types of real estate. That means that EPC is associated with other business operations, and they'll say it's not eligible. All we have to do is require the borrower, if they want to have an EPC, they just have to create a new holding company, or they have to quit claim all of the other all of the other real estate assets out of that entity. So it just makes a lot more sense. It's a lot easier if they just form a new holding company. When a borrower does have an EPC, the SBA requires that they lease 100% of the building to the OC. So if there happens to be additional tenants in the building, then the SBA expects that the OC subleases to those tenants. So when a borrower is wanting to have an EPC, they're going to have tenants in the building, it's important that they understand that the lease that they have between those third-party tenants should not be between the EPC and the third-party tenants. It needs to be between the OC and the third-party tenants. And that is pretty much contrary to any advice an accountant would provide, but that is what the SBA requires. The SBA requires that the rent payment made between the OC and the EPC, that it is not considered excessive. Now, they haven't really defined for us what excessive means, but from experience, we have learned that around a markup of over 20% more or less above the debt service is considered eligible by SBA. Now, the reason that they don't have a cut and dry amount or a rule specifying what that needs to be is that there are certain circumstances where there might be higher expenses in one area than another. I think a good example of that is property taxes. You might have higher property taxes in South Jordan than you do in other more rural parts of the state of Utah. And so the SBA we have found that they have been flexible in certain circumstances where we can show why they have to have a higher rent amount than what is considered normal to the SBA. So we run into a lot of issues when we work with repeat borrowers. What happens is we find that they're not in compliance with these EPC OC rules. And what we have to do is work with them to bring them back into compliance. When they're not meeting these EPC OC rules, the SBA considers them to be in technical default. And SBA will not approve a new loan for them if they are in technical default. So what we have to do is we have to rework leases. We have to get a letter from the borrower stating that in the future, they will not pay excessive amounts of rents, that they'll comply with this rule. So it's not something that is impossible to overcome, but it's definitely, it can be tedious. And being able to work on it and figure this out at the beginning of the process is a lot better than figuring it out at the end. When we speak with you, we want to know if you're aware of any prior SBA loan history from the borrower. Have they ever defaulted on an SBA loan or a prior government loan? If so, they're not eligible for a new SBA loan until they contact the Treasury and basically pay that off. The earlier we know about it, the better. One practice that we have started is that we have started having the borrower give us permission to go to our local district office and look up if they've had any prior SBA loan history. And we've started doing this on every loan. It's actually something we do at the very beginning of the process so that we can detect if they're current or if they've defaulted on any prior SBA loans. And this is just a good reason why we want to make sure the borrower is filling out and signing our application because we have unfortunately had situations where we didn't check on prior SBA history, or we did check and the borrower told us they hadn't had any defaults. The loan goes all the way through our internal approval process. Appraisals are paid for, environmental reports are paid for. We submit the loan to SBA just to have a quick reply from SBA saying this borrower is not eligible, they've defaulted on a loan. So we want to take care of that up front. When it comes to environmental reports, it's important to discuss up front what kind of environmental report is needed and who is going to order it. Is it you, the lender, that's going to order it, or is it us who's going to order it? We want to avoid getting all the way to the point where we've got an SBA loan approved and then realize, oh man, we forgot to order the environmental report. And then that's just going to delay the closing process. Now, we are not going to tell you who you should or shouldn't use to order your environmental reports, but I will say that you should be aware that we have a high percentage of RSRAs that we order from Vericheck that create problems for us. The reason for this is that a typical RSRA will give a low risk or a high risk statement. They'll state if it's high risk or low risk, and they just leave it at that. If it's low risk, we submit it to SBA. no problem. If it's high risk, we have to move on to a phase 1. Well, what Vericheck does is they will give levels of low risk or high risk. So they'll say low risk level 2, and then they'll have a recommendation of something that we should look into. Well, what happens is if we send that to SBA as is, SBA they'll kick it back to us and they'll say there's potential concern noted in the environmental report. So we can try and address those issues brought up by Vericheck. But what happens is if we send it to SBA, we've already delayed the process by taking longer to have to get them more information. It's caused more work for everybody. And SBA may or may not take what we say at face value. So then what we have to try to do is go back with additional information to Vericheck. And my experience is that that's been a bit of a black hole, and they seem unwilling to update their report to just a low risk level 1 with the added information. So what often happens is we either spend a lot of time having to go through the environmental appeals process, or we have to just order a phase 1 or a TSA. And it's frustrating and time consuming, and it can be avoided if we use a different environmental professional. Franchises are always tricky with SBA. So what SBA has done recently in the last few years is they have created a franchise directory. They've worked with thousands of franchises from all over the nation to pre-approve them on that directory. So if we find out that a project involves a franchise agreement, a license agreement, distributor agreement, a membership agreement, a jobber or fuel supply agreement, then we need to check to see if any of those are considered franchises by the SBA or not. And the SBA considers any of those types of agreements. They say that those meet the FTC definition of a franchise, and they need to decide if it's a franchise or not. So hopefully that franchise has already gone through the process of getting approved with the SBA. If not, then the franchisor or the jobber or the fuel supplier or whatever the case may be has to work with SBA to get pre-approved on their directory. And many of you know who have gone through this process that it is so slow. It can take up to 2 months to get them approved and on that directory. And so this is one of the first things we want to check and see when we're talking to you about the loan. Is there some type of franchise agreement involved in this project? If there is, then we want to hop on the directory right away and determine, first off, does SBA consider it a franchise? Yes or no? If they do, is it pre-approved? Yes or no? And if it is pre-approved, what kind of addendum does the SBA require? So that gives us a heads up very early in the process of any additional work that might be needed for the franchises. SBA recently has started to focus a little bit more on historical properties. And it's difficult because it's a little bit of an arbitrary decision on if something is historical or not. And we finally have heard from SBA that if a building is over 100 years old, then we need to go through a process of making sure, they call it a Section 106 review. We have to make sure that there's no adverse effect on this Section 106 review. So I just want to give you a little bit of a rundown of what this process entails. So if we determine that it's over 100 years old, or if it is in a historical district, or it's an actual historic property, we have to provide some information up front to the State Historic Preservation Office, or SHPO. So we send that information to SHPO and they review it. And once they've reviewed it, they'll issue what's called a no adverse effect letter. So then we have to take this letter and send it to our local SBA district office. So that happens for us, where depending on where the project is, that's either going to Seattle or it's going to Denver. And the local district attorney at that office will review the information from the no adverse effect letter from SHPO, and they'll make a determination. After they've made a determination, they have to send it on to SBA's Office of General Counsel. And finally, the Office of General Counsel will state that no further Section 106 review is needed or required. They get that letter back to us, and at that point, we're able to send the loan to SBA. If it's over 100 years or it's a historical property, we can't send the loan into SBA until we have that no further Section 106 letter from SBA's Office of General Counsel. Now, the process can move pretty quickly if we're able to get information that we need to SHPO. You know, they typically take about a week to get us the letter. Once we get that to SBA, it moves pretty quick. But it all depends on, it can depend on how or where a district office might be in their closing process. You know, if they're right in the middle of a busy closing month, they might put off a historical review for a week. So we, of course, want to work on this early in the process and get it figured out early. Credit elsewhere has become more of an issue with SBA. It's another item that they're very focused on. And, you know, we must demonstrate to SBA why a borrower needs a government guaranteed loan. So it's helpful for us to know from you why the borrower wants or needs this SBA loan. Why would they not be able to be approved conventionally? It's not happening all the time, but we have had some loans declined from SBA because SBA felt that they were too strong financially and they did not need the assistance of the SBA. So it's very helpful for us to discuss this issue up front with you and determine if we think it will be a problem. And if it's borderline, we can talk about different strategies we've used to get the loans approved where there might be a potential credit elsewhere issue. Bridge financing is a very important topic. If I'm boring you to death, at least pay attention to these next few slides, because it can save you some time and stress and some potential heartache. So bridge financing is when a lender makes an interim loan before the SBA has approved the loan and issued the authorization. It can be very helpful in certain circumstances, or it can really hurt. And due to recent slowness from SBA and demand of sellers to close on a property in a hot real estate market, we have seen a large uptick in bridge financing. So let me give you some examples of bridge financing. So maybe there's a short-term note that's used to purchase land that the borrower hopes to then turn around and build the building on. Or maybe a short-term note to just purchase an existing building. We typically see this done by a conventional lender, a hard money lender, or even through a seller carryback note. For bridge financing to be considered eligible, it must be short term. So a term of 3 years or less is considered short term by the SBA. 3 years or more, well, yeah, more than 3 years is considered long term by the SBA. So they will not make exceptions for a note that's even 3 years and 1 day. That in their mind is considered long term, and bridge financing is no longer an eligible option for us. When bridge financing is short term and eligible, we include the cost of paying off that bridge note as part of our regular 504 loan. It's pretty simple. The additional documentation that we need to collect is a copy of the note, your trust deed. That's about it. And that makes for a pretty smooth process. But when bridge financing is long-term, we can usually transition the loan into one of SBA's refinancing projects, but not always. We have had deals in certain circumstances that have died because the bridge note financing was not done properly. That's pretty rare. Usually we can come up with a solution, but the solution always means extra work and extra time wasted. A common problem we see is when a lender does bridge financing with 2 notes. So they do one note that's meant to be their long-term perm note, and they do a second short-term note meant to be the interim loan that's eventually paid off by the debenture proceeds. The long-term note will be considered ineligible bridge financing because it is long-term. It's over 3 years. And this could cause delays and major problems with the loan. We do have a solution for this as well, but again, it's easier to just avoid this issue altogether. Another common problem that we've seen recently is when a lender is working on a refinance, and for whatever reason, they want to lock in the rate, or the loan's already got a lot of equity. It's a good, strong loan, and the lender doesn't feel as much risk. So they move forward on that refinance loan and do a bridge loan while we work on getting it approved with SBA. Well, what happens with this is that on refinance, the SBA has a rule that says we can only refinance loans that have been in place for 6 months. So when a lender does a bridge note on a loan that we're looking to refinance, it resets that all of that time that loan has already been seasoned, it resets it. And now, instead of refinancing the original loan that we're looking to refinance, we have to refinance the bridge note or the bridge notes. And we have to let those season for 6 months before we can move forward with that. So bridge financing is not a viable option if we're looking at a conventional refinance loan. I want to just mention a few things about loan documentation. So I mentioned this a little bit before, but MWSBF has started requiring all borrowers to fill out our 504 loan application. So we've updated our application to best suit and aid our back office as they work on processing these loans. And we have found that when we have our application with this very specific information filled out, it has really helped speed up our underwriting and processing process. I wanted to mention, what is needed for us to get our loans into processing and underwriting. So we have started requesting as much information up front as we can get. But really what's needed to get it onto processing and underwriting is a full financial package and our forms filled out. We're willing to get it on into underwriting with that information, knowing that, we're not going to hold it up for a copy of a driver's license, or, we're waiting on a construction bid or an equipment vendor quote. We're not going to hold it up for that, but we do want to have a full financial package and our forms filled out to get it moving through. Now, I mentioned before that we are willing to do a pre-screen, and that is definitely something we're always willing to do. If you have a project that's a little bit borderline, get us the financial information and we'll do a pre-screen as quickly as we can so that we can give you a quick yes or a no. That's obviously not a full approval from us, that it still has to go through our committee, but we at least have a good idea of what the loan is going to look like and think that it's a loan that we can get approved from the beginning. Our forms help us to detect if there's any unusual circumstances or additional information that needs to be collected from the borrower. Good examples of this are if they're involved in a pending lawsuit, if they've had a prior bankruptcy, we might need to collect additional information depending on their citizenship status, and also if they've had any prior arrests. So all of this requires additional information up front. Unfortunately, I think everybody's had an experience where a borrower marked that they had not been arrested on an application, and then once they see the formal SBA document right before we're about to submit, they get scared, or their conscience gets the better of them and they mark, yes, I have had an arrest. So, whatever we can do to detect that stuff up front is always helpful and helps save time. I wanted to mention a couple of best practices that can help with the closing process. So one of them is to make sure when it's needed that we have a certificate of occupancy. If a project involves renovation or construction that requires a permit from that local municipality, then that means they will, in the end, have to have a certificate of occupancy. Our closing attorney requires us to contact the local municipality or city to verify if there's any outstanding permits at that property. And if there are, then we have to have a certificate of occupancy. Our closing attorney won't prepare closing docs without a certificate of occupancy. And the SBA attorneys, so once it gets past us at our internal level and it's sent to our district attorney for their closing review, they won't accept it with a temporary certificate of occupancy. Historically, when we were able to send those types of reviews to our local Salt Lake district office, we had a little bit more flexibility, and we could usually get away with a temporary certificate of occupancy. But the attorneys at the new district office that we have to submit to will not approve that. And so we need to make sure that if a certificate of occupancy is required, that we have that from the beginning on each closing that we're working on. Another closing best practice has to do with project costs. The process of closing will be faster and smoother if you make sure that your loan or loan amounts match the authorization. So we understand, especially on construction projects, that there's going to be changes to that project, and we're going to need to do an authorization amendment to get back in line with the actual project costs. But it can be frustrating, and it can really delay the closing process on straight purchase projects where we find that the notes that come from the lender don't match the approved numbers from the SBA. Oftentimes we see that the lender finds out that closing costs weren't quite as high as they had estimated, or they needed to reduce or increase the origination fee. So whenever that happens and that loan amount is slightly different from the authorization, we have to do an amendment. And it could be a lot easier and save a lot of time, especially when authorization amendments, as recent as a few weeks ago, were taking up to a month to get approved. If you can match the numbers in the authorization, that will make for a much smoother process. So in closing, just want to reemphasize that communication is key. The sooner we can have a phone call with you, the lender, if we want to get the borrower involved, we're more than happy to do that as well. That upfront communication about the project can really help get the project started on the right foot and make it a quicker, smoother process for the customer. There are certain aspects of every loan that we should be discussing up front, make sure that we're on the same page, that we understand everything about the project. We need our application on every loan that we work on. Doing these things, we believe that doing all of these things will help make for a better experience for you and your customer. So that is the end of our presentation for best practices. Before we get to questions, I'll just mention that the fourth webinar in our Masters of 504 Learning is May 26th. The topic is Eligibility 101. And we would invite anyone in your office that is presently or potentially doing 504 lending to attend. And it'll be a great webinar that will cover the basics of eligibility.
Great. Thanks so much, Spencer. Give a couple of seconds here to see if any questions roll in. So far, we don't have any. We really appreciate everybody's attendance today. We had just around 65 attendees. Somebody just raised their hand. I don't know what that means. But looks like it says, thanks for all the great information. We will be sending out these slides to everyone that had registered. And then also, if there are people in your organizations that are interested in watching this later, we have a recording of this and it will go on our YouTube channel. Looks like Marcos Rosa has a question. So if you want to type that in the chat there, Marcos, love to answer it. Or I don't know if we can unmute you or not. Let me see. Okay, it looks like it's a question about citizenship qualifications. Spence, do you want to tackle just who is eligible, what that process looks like?
Yep, okay. So first off, anyone who's a US citizen, that it's just regular process, no additional information is needed. If they are not a US citizen, but have legal permanent resident status, then as long as a business is owned, I believe it's 51% or more by a legal permanent resident, then they are eligible for a 504 loan. Any other citizenship status is not eligible. So visa, like a work visa or student visa, anything that's temporary, they are not eligible for a 504 loan. We have to have at least 51% of the business owned by a US citizen or a legal permanent resident. If we find out that someone is a legal permanent resident, then what we have to do is there's a form that we have them fill out. It's very basic: name, date of birth, current address, their green card number, and we collect a picture of the front and back of their green card, and then we send that to SBA. They do a review with USCIS to just verify their citizenship status. It's a pretty quick process. Once we send it to them, we usually hear back within a few days that they've just verified their citizenship status, and that's all we have to do. Then we submit that documentation to SBA with the rest of the file when we eventually send it off to SBA for approval.
And Spencer, is that across all SBA products or just 504? I imagine that it's the same
so.
Across all products.
Yeah.
Great. Okay, from Mike, if you have a debt refi of a conventional first and securities-based line of credit second, is that eligible?
Yeah, so a line of credit is eligible for us to refinance, but the way we have to do it is there has to be sufficient equity in the property that we can pull cash out. SBA calls that eligible business expenses. So if there is sufficient equity and there's enough for us to pull enough cash out, they are able to use that to pay off a line of credit.
Great. And Mike, that sufficient amount is we can only give cash out up to 20% of the appraised value.
Yeah.
Great. Well, we're nearing the top of the hour here. We want to get you all back to your day. Spencer, thank you so much for presenting today, and thank you all for joining. And as I said, we'll send out these slides so that you'll have them available, and then we'll also get it posted to a YouTube channel. So if you need to disseminate it across any of your team members that weren't able to join today. Thanks so much, everybody, and have a great rest of your day.